And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The tax wars have come to ETFs. Senate Finance Committee Chairman Ron Wyden has proposed a new tax on ETFs to help pay for the $3.5 trillion budget plan. The measure would stop investors from avoiding capital gains on so-called in-kind transactions, which allows traders to swap the underlying assets for another without producing capital gains. This is one of the big advantages of ETFs, folks, and it's on the chopping block. The ETF industry fighting back. Let's talk with Eric Pan, CEO of the Investment Company Institute, which represents mutual funds and ETFs. Ed Rosenberg is the Senior Vice President and Head of ETFs for American Century Funds. Tom Wyden is from ETF Trends. Eric, briefly, for those who are not familiar with all the advantages here of ETFs, what's an in-kind transaction? Why did the Democrats want to tax it? And why is this a big concern for the ETF industry?
Sure. So in-kind transactions are how ETFs manage their portfolios. It means when you sell a stock and you get a stock back, that's not considered a taxable event. Not 1969, IRS came up with a rule that said we're not taxing that. And since then, we've been relying on that tax rule. Senator Wyden would like to now make it a taxable event because he's trying to raise money. And the problem is he's punishing the investors. Because what happens is when you and I buy an ETF and we buy, we hold, and we don't sell for years, we pay taxes only upon sale. Senator Wyden would make us face a tax bill every year, and that's not fair. And that goes back to the point of it's bad policy because we're punishing long-term investors. We're making it more expensive for them. And this is dangerous. You know, today, a lot of people are interested in the markets. They're doing crypto, they're doing meme stocks, but we want people to invest for the long term because they got retirement goals or they've got education they need to pay for, their kids. They want to buy a house one day. And so Senator Wyden's actually, with his tax bill, is actually going to make it more expensive for these people to save for the long term. And that has real consequences.
You know, Tom, I can't help but think this is only one tax proposal that affects the financial businesses. There's plenty of other them out there. Biden also wants to boost the capital gains rate, now at a top rate of 20%. He's proposed boosting the top tax rate from 37 to 39.6%, and also having that same 39.6% capital gains rate apply to households making at least $1 million a year. How would that proposal affect ETFs as well? I can't help but think it's not good news.
Well, it's not good news. It's not good news for Wall Street. But if you think about those that are making $1 million or more a year, you know the government's coming after you. I think the key thing, though, is Biden has promised that if you make under $400,000 a year, don't worry, your taxes aren't going to go up. And what we talked about earlier is 92% of households, and there are 12 million households in the U.S. that own ETFs. They make less than $400,000 a year. Their median income is $125,000, Bob. So they are surely in that camp. We're supposed to be protected. And if this goes through, they won't be.
You know, Ed, none of us want to see higher taxes. I certainly don't. But how bad would this really be for the ETF business? I mean, you still have low expense ratios, right? That's not going to change. Would this change the way managers really run their funds? What's really at risk here?
I mean, it definitely is going to change the way managers run their funds. They're going to take more losses throughout the year or throughout time periods when there isn't rebalancing, which is really going to increase trading costs in the portfolio, which can dampen performance for clients. It's also going to increase selling of individual securities throughout the year and put more pressure on the sell side. Now, in smaller funds, obviously, it's not that bad. But as you go to the larger funds and they're trying to manage their tax lots to keep gains at a minimum or at zero, there could be a lot more selling that goes on, especially in markets that have dropped or, you know, sideways markets like today where you see parts of the market up and down. You could see more selling on those securities that are already down to build up losses in the portfolio. And really what it does is it changes how a portfolio manager in the ETF space is going to have to manage ETFs going forward if something like this went through.
You know, Tom, what is the rest of the ETF community doing about this? I mean, the big kahuna here is BlackRock. I mean, they manage, what, $9 trillion? They're a big ICI members. I can't help but think behind the scenes, they're pointing out what damage this would be to even average Americans, as you pointed out, not people making more than $1 million a year, but just people making $125,000 a year.
Yeah, well, a lot of people listen to people like Larry Fink for sure. I mean, what he's done for ESG has been really admirable, but we need him now. And I think Eric has a lot of the heads of these fund companies and ETF issuers together right there in Washington, D.C., probably doing what they need to do, which is rally around the tax safety of ETFs. I mean, we all know, Bob, we've been looking at mutual funds for a long period of time. And there's been periods when the market's underperformed, your mutual fund is underperformed, but because your fund manager had to sell low cost basis stock, you've been gifted this great distribution at the end of the year in the form of a taxable gain, when in fact the fund's gone down. ETFs haven't had to deal with that. And the great thing about it, when I look at Eric's organization, they see the benefits of ETFs, the industry's coming together. It would be a travesty if something like this went through.
Eric,
Bob,
do we know?
Bob, if I could say,
Go ahead. Go ahead, Eric.
Bob, so this is not about BlackRock, right? This is about retail investors, millions of Americans who own ETFs, and they own it through BlackRock, but they also own it through many, many different companies. And the fact is, why is this tax being added on them? Because they're the ones who ultimately are going to have to pay for it. Is this what we want? Is this really the objective? I get that they want to raise revenue, and raising revenue is an important piece. The taxes also affect behavior. It's about policy and whether or not we want Americans to invest. And that's why it's dangerous.
You know, but we know why this is happening, because $3.5 trillion is an awful lot of money, and you got to go very deep to get that. I mean, realistically, have you run numbers, Eric? How much money would this actually raise here? Your point is they're going after the wrong tax base, but you've got to go pretty deep down to raise the kind of money they're going to need, right?
Well, so I haven't done the calculation, and I believe the Congressional Budget Office is going to score this quite soon. But there are many ways of raising taxes, and the question is, who's paying these taxes? 12 million American families earning $125,000 a year, they're the ones paying these taxes, right? We look at young Americans, 33%, okay, of millennials have ETFs as part of their investment portfolio. We talk about Gen Zers, 29% of them own ETFs. So these are the youngest Americans who are just starting to save today. They're the ones who are going to be paying these taxes. So is it going to raise money? Sure, it'll raise money. Should we be raising money this way? No.
So you're the lobbyist, Eric. Handicap the chances this could pass.
Look, Senator Wyden is the chair of his committee. There's a possibility it could pass. I wouldn't be speaking to you today if I thought that this wasn't a proposal that had a chance. But I do have faith in our system that our policymakers want to do what's best for the country. And I'm hoping they're going to listen to the arguments, look at the merits, and realize this is a bad way to go.
Ed, for people who aren't aware of how the in-kind transaction works, give us a simple example of how, like, an authorized participant creates and redeems shares in these ETFs, and how that does not create a taxable event. I want to make sure people just understand how this works, because this gets into the plumbing of ETFs, but it's always important for people to understand how important the in-kind creation, in-kind transactions are.
Yeah, Bob, it's pretty simple. So just use an example of somebody buying 100,000 shares. They put that trade in through their broker. That broker puts the order into the market. If the market doesn't have enough shares, it ends up on the desk of an authorized participant. That is the firm that is able to create or redeem an ETF shares. So they will gather the underlying securities that make up the unit of that ETF and exchange those for ETF shares. And when they do that, using an individual security, let's just say it's Apple, and it's $150 a share, the fund takes the cost basis the moment it comes in at $150 a share. And so that's when it comes in. And then ultimately, that once all those shares come in, the underlying securities, the shares are released and end up back in the client's account. If you do it the opposite way, when there's a redemption and the fund takes, what happens is the fund will then take all the underlying securities that make up that basket and move those out to the authorized participant. So in this case, I mentioned Apple was $150 a share. Let's say the fund paid $130 for that. The fund, it moves it out, and there's no gain on that sell. So somebody had sold enough shares, 100,000 shares, to cause a redemption, and that $20 gain in that security goes, no one pays that. So it goes from the fund to the authorized participant. The difference here, though, is this is not just an ETF rule. Mutual funds can do in-kind redemptions and in-kind money coming in, but also what you've done is, because the person who sold and caused that redemption isn't impacting all the other shareholders that own it, he or she is choosing when to take that capital gain by selling the ETF itself, as opposed to burdening the capital gain with all the underlying shareholders at a time they did not choose to sell. And so it's really creating a different. I'm sorry, go ahead.
I know this gets a little wonky, but I want people to understand the difference between that and what happens in a mutual fund, and how that can create a different situation.
Yeah, so the mutual fund, most people aren't buying in, $5 million lots, which is or 2 million or 1 million, which is the way ETFs work on the creation redemption. It might be $3,000, $5,000, $10,000. And when that happens, a portfolio manager may have cash on hand to meet that, or may have to sell to cover some of that. However, the nice thing with a mutual fund is this rule that Senator Wyden's going after applies to all registered investment companies, which is ETFs and mutual funds. So if there's a redemption large enough in a mutual fund of $5 or $10 million, the firm can choose to redeem those securities in kind and save the rest of the shareholders the tax burden that would be caused by someone selling that large amount. And that has happened in the past. Most mutual fund companies use that leverage or use that process when it's such a large redemption. But mutual funds have much smaller transactions, and because of that, you can't use that in-kind process on a regular basis. And you have to think of it this way, Bob. 80% of transactions that occur in ETF occur on the exchange. They do not cause a creation or redemption. It's usually just that other 20%. And that 20% can impact the shareholders of that fund dramatically if a rule like this was passed and everyone's taxed on every redemption.